It's time for the Money Puzzle Podcast. With good conversations and realistic solutions to the money puzzles we all face every day. I'm your host, financial advisor, chartered financial consultant, and president of Edgen Insurance and Financial, Robert Edgen. Now let's get this show started. Hi there, hello, and welcome to the Money Puzzle Podcast. I am Robert Edgen, and I'll be your guide for the ride for the next few minutes. Each week, we'll look at a different piece of the money puzzle and practical ways to solve it so you can have the financial confidence you deserve and the
future that you dream of.
That's right, the future that you dream of. This is episode number 47, and today we're talking about IRAs and the differences between traditional and Roth and how they affect your taxes. Now, by now, you should have received all of your 1099s and you should be well underway towards filing your taxes. But before you do, you still have time to get some extra tax deductions and save a little bit extra for retirement with a traditional IRA.
Yep.
Or, depending on your situation, save more for retirement and then save on those taxes in the future with a Roth IRA. So we're going to talk about the difference, and to help me talk about those differences, my buddy, my pal, and my business partner, the investment brofessor, Brian Johnson, in the studio with me today. Thank you for making the drive down.
You're welcome.
So always exciting to have you down.
I'm so glad you came up with a different name for me.
I work on it. It takes me time. You know, Brian and I have been business partners for a while, but we operate out of different cities. Our offices are what, 90 minutes away, hour away?
Well, yes, with traffic,
depending on traffic. Somewhere between 60 minutes and 400 minutes,
right,
depending on traffic. So, yes. So today, I know you have been very busy as I have. We're in the middle of tax season.
Yep.
Are you coping okay? Are you handling the stress?
Yes. When I got down here today, I got a call. Hey, where's my 1099s? I got to have this. I got to have that.
Yes, which of course we personally don't mail out the 1099s.
No,
the financial institutions do,
right,
but we can call and check. And my guess is it was mailed on time.
Yes, mailed on time.
Yes.
All they got to do is look at their emails.
So, yes. All right. Well, I'm excited to get into this conversation today because it is tax time, and you can use IRAs as some great tools, not just for saving for retirement, but also along with some tax stuff too.
Yeah.
So we're going to get into that. It's going to be awesome. But before we do, I do a lot of reading and research, and I come across different financial news stories that catch my eye. So I thought we would take a minute to look at some news. All right, this week's story comes to us from UPI.com, and the headline reads, New York State students buy a plane ticket to score Chick-fil-A lunch. So here's the story. A group of New York State students, college students, who were craving Chick-fil-A came up with a scheme that involved buying an airline ticket to get their Chick-fil-A. The cross-country and track and field teammates had a week off from competition in this little school in upstate New York. They really wanted Chick-fil-A for a team lunch. The only problem, the closest Chick-fil-A was a 90-minute drive away, or there happens to be one Chick-fil-A in their airport on the other side of security. So,
no.
What did they do? They each chipped in $5.50. They bought the cheapest one-way ticket they could, which was $98, to get one of their guys through the security line, who then went and spent $230 worth of Chick-fil-A, or bought it, for 15 sandwiches, 15 large fries, 13 orders of 12-piece nuggets, a bag of cookies, and one lemonade. That one actually, is that one lemonade?
It was for him. He was thirsty.
That's right.
That walk between and waiting in the security line.
He deserved an extra lemonade. And then here's my other question. Why didn't they just call the Chick-fil-A and offer to pay one of the people $20 to walk it out to them?
Yeah.
So I don't know. But, they spent $98 just to be able to spend $230. If I was Chick-fil-A, I'd be running this as a commercial or something.
Right. Why not? I mean, that's how good their food is, I guess.
That's what my wife says.
I don't know. I don't either.
My wife loves Chick-fil-A almost as much as she loves me, maybe more, just depending on her level of hunger.
Last we talked, what number on the list?
I was number 6. Yes, number 6 on the list. She's got the kids and herself and our 2 dogs. So
in the house.
Yeah, the house, and then me. So, but I'm blessed and honored to be number 6. Okay. So I'm happy with it. All right, the rest of that story, if you want to check it out, I've got the link to it below the show, or in the show notes, directly below the video and below the podcast. So go check it out. But for now, let's go ahead and
Do not copy what they did.
I agree. It's not the best financial advice.
Yeah, no.
Or at least, try calling them and see if they'll walk it out. I mean, for a $230 order, the manager should walk it out.
What, for a $10 tip? Or
So,
$20? If they gave him a $50 chip, it would have been cheaper.
It would have still been half price.
Did I say that right?
So, yes, you said it right. So,
Okay.
All right, go check it out. But for now, let's go ahead and get to today's hot topic. All right, let's talk about traditional versus Roth IRAs. What are the differences? Which one should you use? And how do they affect your taxes, which you are probably about to file, your taxes for 2019. So, Brian, if you would like to get us started, why don't you give us a quick breakdown of what a traditional IRA is?
Simple and easy. IRA is a wrapper that identifies to the IRS the tax status of the funds that you invested or saved. So you put up to
$6,000. So what does an IRA stand for?
Individual retirement account.
Yes. So, we always call it an IRA, but that's really all it is an individual retirement account.
Yeah.
So I'm sorry. Okay. So you can put into it how much?
$6,000.
$6,000 unless you're over the age of 50.
Right.
And you can throw another $1,000.
$1,000. Yeah.
So it's before tax money, correct? Pre-tax money.
It is, as long as you meet certain income requirements.
So being pre-tax means that it will give you a deduction on your taxes today.
Yeah, it comes off your income.
Yep. Okay.
Today, it is taxable when you decide to start taking it in retirement.
But it grows with no tax.
It grows tax deferred.
Tax deferred, correct.
Tax deferred comes out taxable.
You don't get a 1099 at the end of each year while it's growing. It sits there. It's money to save for retirement.
Yep.
But you cannot touch the money before when?
Well, 59 and a half without having a penalty.
So
after 59 and a half, you just pay ordinary income tax.
Okay, and we'll come back to that penalty in a minute. But here's what happens with a pre-tax contribution to your IRA. It's not like you get to save the money on the taxes throughout the year when you do it.
Right.
But at the end of the year, there's a question on your taxes that says, did you contribute to an IRA?
Yep.
And if the answer is yes, you get to reduce your income by that amount. So I just did a quick example. Right, you make $60,000 a year. You contribute 10% of your income. That's $6,000. Right. So then, when the IRS looks at your income, they actually see it as $54,000 because you got to reduce it by your contribution.
Right. So as you move down through your tax return, that's how it works. Your W-2 will still show $60,000.
Correct, but your taxes would show $54,000 before your other deductions.
Yeah, before
just
everything
for
else.
Simple stuff. So if you're in a 25% tax bracket, which just picking a number for easy math, that means it would save you $1,500 in tax off of that $6,000 of income by putting it into your IRA.
Right.
Right.
And you have all the way up until tax day,
April 15th.
To put it in. Yep.
So that's right.
Or make that contribution. Yep.
That's right. Or make that contribution. All right. So let's say how a traditional IRA, sometimes people call it a regular IRA.
Should we go over the income limits?
So we will in just a minute. Okay. But I want to talk about Roth first.
Oh, okay.
Just to compare the two.
He's a nice guy.
So
I really like Roth.
So, in fact, a lot of people, this is actually the first point that I have here. Normally when I see people write out Roth or they email me and ask me about a Roth, it's all capitalized. Just like an IRA is all capitalized. But an IRA stands for something. A Roth is actually a last name.
It's the last name of someone, yeah.
So that's right. It's actually the last name of the Senator William Roth who sponsored the bill that brought the Roth IRA into existence.
He deserves a bonus.
So his name will forever go down in history.
Yeah, but nobody knows that. No, not really. I think you should get paid for every time somebody says Roth.
Oh my gosh, that would be insane. Even if he was paid a penny,
right?
Every time somebody said the name Roth. So Roths came about in 1997. It was actually a bill that was sponsored by Senator William Roth. So they named it the Roth IRA, which I think is pretty darn cool. It has the same idea as an IRA, but the taxes work in in the opposite way. So, you can still put in $6,000 and it's still going to save money for retirement. But instead of getting that deduction from your taxes for that $6,000, you get no deduction.
No deduction whatsoever.
You save no money on taxes.
Yep.
It still grows tax deferred, but the difference is it's actually growing tax free if you treat it right. Because then when you take the money out, you don't pay any taxes.
Zero. Right? Isn't that, that's why I love him so much.
So, we don't really care for taxes.
Right.
And this is a way to not pay taxes in retirement. So he's a pretty cool guy as far as I'm concerned too.
Brilliant. Just think about the brilliancy behind that, really.
So, it not only grows tax-free, but your distributions are tax-free, but you do have to follow two simple rules. The growth or the gains in your account must be left there until after age 59 and a half.
Yep.
That's the same as a traditional IRA. Otherwise, it's a penalty, right? And number two, you've got to wait at least 5 years from starting the Roth before you access that growth or the gains. You can take all of the money out that you put in at any time. Why? Because it's already been taxed.
Yes, and I get this question sometimes too. Oh, can I take that out and then put it back in? No. Once it comes out, it is out.
That's right. Which is, if you had an emergency and you needed it and you didn't have an emergency fund and you could go take $5,000 out of there, it solves the emergency problem. But you're right, you cannot put it back in. So now it's not going to grow and it's not going to do what it's supposed to do.
Just leave it there and forget about it.
Well, now there's also something else important when it comes into your retirement mode and taxes when it comes to a Roth.
Yeah.
Because a Roth is non-reportable income, which means it doesn't affect your Social Security. Right? Social Security, a lot of people don't realize it, and we'll have to do a different episode on this, but Social Security will be either no tax, half tax, or 80% of your Social Security will be subject to tax, depending on how much income you earn.
That's right.
Right?
Yep.
But Roth IRAs don't count as income.
That's why Social Security planning is very, very, very important.
Yeah. So if Roth IRAs sound this cool and you get all this great stuff in your retirement, why would anyone ever contribute to a traditional IRA? Well, I have an example for that as well.
Let's do it.
Okay. Looking at that same person who earned $60,000, okay, and they wanted to contribute 10%, so $6,000, but they wanted to do it to a Roth. Well, first off, it's going to come out taxed. So instead of getting, $6,000, if they're in that same 25% tax bracket, then they're only going to get $4,500. Right. So they would have to come up with $1,500 out of their pocket, which is what we would encourage them to do, to still do their $6,000. But maybe they cannot. Maybe they're stretched and all they can do now is, $4,500.
Right.
So I just ran a comparison of of looking at somebody who was in a 20% tax bracket, putting away $6,000 for 30 years at 7% interest.
I can't see without my glasses.
That's okay.
Okay.
You're older. You're older than me.
Right. By a few months.
A few months, I'll take it. So I looked at, a person who's in a 20% tax bracket, $6,000, 30 years, 7% income. If they put that $6,000 into an IRA for 30 years,
7% return.
7% return. What did I say?
Income.
Interest is what I meant to say.
Yeah, there you go.
Yes, but a return. It would be worth $606,438, but then they would have to pay 20% tax. Right? That's $121,287, which means that they would receive $485,151. Now that's under a ridiculous assumption that somebody would say, "Give me all my money right now."
But we're being ridiculous. Yeah, why not?
Compare that though to a Roth where I couldn't put away the whole $6,000 because I had to reduce taxes.
So you do $4,500 for 30 years,
same 7% interest. You get $454,000. So it's actually $30,000 less.
Yeah. Almost 31,000 less. That's a lot of money.
Now, what we try to tell folks is if you can put away $6,000 by your IRS limitations, put away $6,000.
Right.
Because then that in a Roth, that whole $606,000 would be worth $606,000.
Right.
But if you've got to reduce for taxes, you can see sometimes a traditional actually ends up slightly better. Sometimes. So it looks like the traditional is a better way to go, but there's a big unknown here.
Yeah, and the unknown is
future taxes.
We have no idea. What we do know right now, taxes are cheap compared to what they have been in the past.
Yeah, we are at our lowest tax rates in the history of the country.
Yeah, huge.
Right? So, so it's fine. You're in a, 20% tax bracket today. Maybe you'll be in a 20% tax bracket in the future, but a 20% tax bracket might not exist in the future. It might have been moved to a 30%.
With $21 trillion in debt.
So what's the likelihood with debt getting bigger and all these problems that they're going to stay as low as they've ever been?
Yeah.
So one of the reasons that experts suggest using a traditional IRA is because in theory, you'll be in a lower income earning position and a lower tax bracket in retirement.
That's what has been said for decades.
Right.
What is the reality?
Well, if you're making... if you're at a lower tax bracket, first off, you might not be earning enough, but second of all, you might be in a lower tax bracket, but the whole tax system might be higher.
Yeah, well, that, absolutely. But if you do your planning appropriately, like if you listen to us and do what we suggest, then you'll have enough money to live on your current income at retirement that you have right now. So will you be in a lower tax bracket? No.
Probably not. Probably not. But yeah, if a tax bracket goes up, even if you're in a lower tax bracket when you retire because you're earning less money, so that's the problem, right?
Yeah.
We just don't know what
idea.
The future taxes hold. So what if that is the case then, and then I want to do both, right? Can I do both a traditional and a Roth IRA? Kind of. You can, but you have to split it. If you do $4,000 in traditional, you can only do $2,000 into your Roth. That's right.
That's it.
So maybe it makes sense to do some of each. My wife and I actually do one of each, but she does a traditional. Okay. I do a Roth. That way we can get the best of both worlds.
I do traditional. I do a simple is what I have. Mm-hmm. And my wife, we do Roth.
So can everyone contribute to a traditional or Roth IRA? Brian?
Most people can. There's a yes and a no in that question. So the yes is this, depending on income limit. What are the income limits for last year? 100 and
if you're single
is 137,000 at the maximum because there's a phase out in there. And if you're married, the maximum is 203,000 in adjusted gross income. Mm-hmm. That's the phase out. So if you're 193,000 as a married couple or below, you can fully contribute as long as you don't have an employer-sponsored plan.
That's right. If you do have an employer-sponsored plan, all you need to know is that those income limits go down.
Yep.
So there's different phase outs, but if you don't have access to one, then you can put money into a traditional IRA. But a Roth IRA definitely has some income limitations. As a married couple, once you reach 193,000 of adjusted gross income, they start phasing out how much they let you save.
That's
now,
right.
Why would they? Why do they do that? Why do they limit how much that we can save?
Do you want my opinion or do you want the real answer? Because the real answer, I don't really know. What my opinion is because the more you make, the more they want. And with the income inequality, as they say these days, we're not going to get the benefits.
So up to 193,000, you can contribute to a Roth. If you're married, it's 122,000 if you're single, but there are limitations. Yep. And then one other thing I want to talk about is, can you get money out before you retire? Well, the answer is yes, if it's a qualifying reason.
Yeah.
Which you've got some first-time home buyer rules, you've got some sickness and illness rules, but if it's not a qualifying reason, you can still take the money out, but it's going to hurt really bad.
Yeah, it's a 10% penalty plus ordinary income.
That's right. Which is
so if you took 10,000 out, it's going to cost you 1,000,
right?
Plus your income tax bracket on 10,000. So on the 20%, it's going to cost you $2,000 for a total of $3,000.
That's right.
That's a big tax.
It hurts.
It does.
It hurts a lot. And think about all of the gains that you've given up with penalties and taxes while you're right. So the bottom line is don't take the money out till you're 59 and a half or older unless it's a qualifying.
And again, you can't put it back in. So once it's out, it's out.
It's out. All right. So what is the bottom line? Which one should you use, a traditional IRA or a Roth IRA? My opinion is it comes down to, when do you need tax breaks? Do you need them now, or do you want to postpone those breaks now and get them in the future?
Yep. Well, one of the things that I've been doing, because of tax rates, we've talked about it, for myself and some of my clients, is I've been converting their old traditional IRAs into Roth IRAs. Now you might as well pay it at a lower tax.
Yeah, if you don't need the tax breaks now, or if you're willing to give up some of those tax breaks now, then we know what the tax rates are. They're the lowest they've ever been. But at the end of the year, if you're filing your taxes and you owe $4,000, you might want to do a traditional to knock your tax bill down to $2,000, right?
Or by $1,500.
So
use that example,
right?
Yeah.
But if you're at the end of the year and you're getting $1,000 back, well, shoot, there's no reason to do a traditional.
No, you go to a car dealership and buy a car.
Okay,
you don't do that?
That's not true.
Okay.
No. But you would want to contribute to a Roth if you don't need those back. So again, you've got till April 15th in order to get that done. So if you've not done it yet for 2019, you got about 6 weeks left as the time of recording this, probably 4 weeks left by the time it hits. Make sure you get it
Something
done.
like that. Just get it done.
So, all right, that's it for this week. I hope you got some value from the show. Thanks for coming down and spending some time with me, Brian. If you did get some value, please make sure that you share us with your friends, your family, your colleagues who need to hear it, and make sure that you give us a rating on whatever app you're listening to us on. Also, if you want to go see what we are doing, then go check out the YouTube channel. The link is right in the show notes as well. And as always, email your personal questions to questions@yourmoneypuzzle.com. All right. Until next week, be safe, have some fun, and do something to help solve your money puzzle. Your future self will thank you for it.
Registered representative of and securities offered through Securities Management and Research, Inc., SM&R. Member FINRA SIPC. Investment advisory services offered through BFC Planning, Inc. Edgen Insurance and Financial Services, Johnson Financial Services, SM&R, American National Family of Companies, and BFC Planning are independent entities. There are risks involved with investing which may include market fluctuation and possible loss of principal value. Particular investments may not be suitable for certain situations. Carefully consider the risks and possible consequences involved prior to making an investment decision. Our firm does not provide legal or tax advice. Be sure to consult with your own legal and tax advisors before taking any action that may have tax implications.